let's talk about candlesticks. Okay, as said, candlesticks are a very, very, very important part. Like if you open the charts, the first thing that you're going to see is candlesticks, and the way a candlestick is performing and the way a candlestick has been reacting or behaving around a certain area gives you an idea on how to mark up a support and resistance, how to understand an area of support. It could be because there's an engulfing candle, or it could be hammer or anything. These things show where the buyers and sellers basically stepped out or stepped in. Okay, so I'm going to get into detail. I'm going to show you the main structures of the candles, but let me show you what we're going to be talking about today so you have an idea. We're going to be covering about what is a candlestick. Of course, it's important for everyone to understand what is a candlestick and how is it formed. Then the information a candlestick contains and part of the candlesticks, because a candlestick is not only just a candle. It's a body, it's a wick, it's the volume, it's many things. Okay, the difference between bullish and bearish candles and how they reflect buyers and sellers. Every time when there's a direction in the market, it's simply because of how much volume or power is coming in from either side. There's only two sides of this market, which is the buyers and the sellers. So the candles decide difference between bullish and the bearish. That allows traders like myself and you guys to understand where is the volume actually stepping in and how is it looking like, what wicks are and what they tell us about the price rejection, how candlesticks reflect volatility in gold market, what candlesticks are important for timing entries and exits, key candlestick patterns, simple ways to analyze candlesticks using context and structure, and a practical candlestick cheat sheet to help you apply what you're going to learn today. Okay, so the importance: every candlestick shows you the results of a battle between the buyers and the sellers. That's what a candlestick shows you. Candlestick is when the buyers, as I said, when the buyers step out and the sellers step in, or the buyers were trying to push but then they couldn't win because the sellers were more. So it basically tells you a battlefield between them two and who won. The bodies show you who won. Okay, the wicks show you who tried but failed. Wicks basically tell you that. Like, I don't know if many of you knew this, but wicks basically tell you that there was these people, when there's a huge wick on one direction, those people tried their best, but it didn't go in their favor and they failed. That's what a wick does. It tells you that. A longer wick means buyers try to push the price higher, but then they got rejected. That's what a longer wick means. A long lower wick means that the sellers tried to push the price lower, but they got rejected. Either way, the wick basically explains that the other people did not win. But there's many other things apart from that you have to consider and be mindful of in this industry, in this market, because they can be fake outs. That's what happens a lot of times. So when you ever see a fake out happen or anything like that, that could be because the candle gave all the confirmation, the direction gave all the confirmation, the support and resistance gave all the confirmation, but still the manipulation can still happen. Hence why it's always important to follow risk management, because this industry is not a get rich quick scheme. Anyone and everyone who ever comes into this industry thinking that you're going to get rich overnight, you're not going to survive for any longer than a month. I'm being straight up honest, blunt to you. These things, they matter, but at the same time they can be manipulated too. So it's important to know all these things but still follow risk management. Here's what most traders miss. It's about the individual candle. It's not about the individual candle. It's about what multiple candles are telling you together. That's very important, because if you're rushing, you're not going to survive any longer. You're not going to last for too long. 3 green candles in a row is what majority of the traders look for, that looking for momentum. That's what is a major confirmation. Like at least two to three. Yeah, that is very important. A tiny candle with a wick on both sides formed by a massive candle. That is a decision breaking into conviction. Okay, the market has finally picked a side and now will expand rapidly. That's basically what it means. So the moment you start reading the stories that the market is telling you which candlestick this is when you become profitable. Okay, when you start understanding the candles and the volatility of the candles and the area where it's heading, what it's doing, that's when you start seeing the profits that you want to see. What is a candle now? As mentioned, we need to understand first and foremost what is a candle. Now, everything we discussed, it comes down to what is this? Movement, firstly. It's basically on the charts, it's the movement showing buyers or sellers stepping in. A candlestick shows how gold price moved during a specific time. It could be 1 minute, 5 minute, 1 hour, all of the time frames. The four key points are the open, the high of the candle, the low of the candle, or the close of the candle. These are the four key prices. They help a trader understand and decide what direction to look in. Where did it open? What was the highest point it went to? How much wick did it create? How much was the wick smaller or the bigger? Where did it close? And all these things are the key four pieces. It's battle between buyers and sellers, as said. Each candle represents the battle between buyers and the sellers. At every moment in gold market, there are buyers trying to push price up, and there's sellers trying to push the price down. Price moves based on who is stronger. That's what simply it does. That's very important for everyone to understand. What information does a candle contain? As mentioned just now, where gold started trading, where the let's say now the markets are going to open tonight at 11. The open of the first candle is where the market actually started trading. Very important to understand. Did it start from the bottom or did it start from the top? And then afterwards, where did it end? Like, if it started from the bottom, did it end lower or did it open above it? That's another very important thing. High price, how high did it reach? Low price, how low did it go? And then of course from there, we look for three other candles. Remember, this information helps you understand market strength and direction. Parts of candle. Body, so this is the body, this right here. This is this red and green bit. This is what is called a wick. Majority of you already know this, but I'm just trying to refresh and let the people know who don't know about this. Body shows the difference between open and close. Big body, strong move. Small body, weak move or indecision. Whenever the candle's going to perform or do something, the wick's going to go and reject some area, then the body's going to be formed. That's how basically it does. And then that's then is your key area for you to understand, okay, I can utilize this and I'll see how many times does the market use this area. Bullish versus bearish candles, buyers versus sellers. Bullish candle closes higher than open. Buyers are in control, shows buying strength in gold. That's what a bullish candle does. A bullish candle are a lot more in favor for, of course, the upward direction or the move to carry on the continuation of a uptrend. You can say that's what bullish candles shows you. A bearish candle is is lower than the open. So whenever the market's going to open, as said, if the candle closes below the open, and then that clearly shows us that the sellers are stepping in, and it shows the selling is in pressure. Okay, large candles, strong conviction. Small candles, uncertainty. That's basically very important to understand. So when the movement of the candles are so small that it's not even showing much volatility, it's better to weigh. And when the candles are pulling in and there's strong conviction, that's when you can be like, okay, now I can look for something. What is a wick in a candle? A wick shows price rejection. Okay, it could be from the bottom or it could be from the top. It tells us where the price tried to go, but it failed. That's basically what a wick tells us, that the buyers tried to push, let's say the market is at 4,500, the buyers tried to push it to 4,510, but there's a huge wick which is bigger than the body. That means the buyers failed and the sellers won over there. It tells us where the rejection often happens at support and resistance. As said, you can use that data to understand the specific area, and you can use that then to be a support or a resistance. Okay, in gold trading, long upper wick, sellers rejected higher price. Long lower wick, buyers rejected lower price. A lot of times you'll see that when there's a huge wick is basically when a lot of buyers step in and they just push the market back up. Because when there's a huge investment in anything, like let's say that you put in 100 billion in gold right now, what is that going to do? That clearly shows that there's a huge investment that's come in and it's going to push the market up. So that's what basically how it works. And then if a lot of people who were holding a position, they sell it, or a lot of people invest into price dropping, that's what creates the wicks. Wicks are very important in gold as they protect you from false breakouts, show volatility and market motion, helps you with stop loss placement, improves entry timing. They are really there. But as you're gonna go, put it this way: that for the next 6 months, every month, twice on Sundays, when I'm gonna be doing calls, these are gonna be step by step guidance. So today's call is about candles. The next one, I'm gonna show you guys what support and resistance is, and you can understand how can you enter, how can you use that support or resistance being broken as a entry point or as a stop loss. But these are the first initial steps to understand that. Now there's way too many types of candlesticks. I've only managed to cover 10 today, because if I cover all of them, this would be a very, very long topic. So let's talk about the first type of candlestick, which is the spinning top. A spinning top has a small body with a upper and a lower wick of similar length, as you can see here. The wick at the top and the bottom is very similar. It shows that the buyers and sellers were active, but neither side gained control. So which means there's not many people actually pushing it. We saw this quite a lot in December, when like the wicks on both sides were very similar. The body size was very, very basic. It's simply because no one could gain control, because benefits are highlights market indecision, useful as a warning sign after stronger moves, helps traders prepare for possible pause or reversal. Drawback: does not give a clear direction on its own, needs confirmation from the next candle, and can be misleading in choppy markets. That's basically, in choppy markets, this is a very common thing. You'll see this actually gives a confirmation that it's a choppy market. Second thing, shooting star. A shooting star has a small body near the bottom and a long upper wick, which is right here like this. It usually forms after a upward move and shows rejection at the higher price. So when we will see a bullish trend or a upward trend, a lot of times this sort of candle is formed at the top. It's very, very common, and it's called a shooting star. Benefits are, it's a strong bearish warning at resistance. It basically shows that the buyers are now stepping out and the sellers are stepping in, and the volume is now changing its course. That's what shooting star really helps a trader to understand. Clearly shows sellers stepping in, very effective in volatile markets like gold. This sort of candle is very common. You'll see this over and over and over again. The drawbacks are, needs confirmation, bearish close after. So it's not just about the hammer or the shooting star being formed. It's about what did the next candle do, because that is a major confirmation that a trader needs to look for. It's not just about this, it's about the next move. It's about the three candles. Can fail in a strong uptrend, less reliable if not at key level. Okay, very important. If like, let's say that you can clearly see that there's an area of interest at the top where the market has rejected and bounced from numerous times, and the market's not got to that, this could easily be a fake out. The next thing, hammer. This is basically, put it, the other one that we spoke about just now, shooting star, is the opposite of that. Hammer is a small body at the top of a long lower wick. It forms after a downward move and shows buyers rejecting the lower price. Strong bullish reversal signal, easy to recognize, very effective as support levels. Again, it requires confirmation. Again, as said, if that, let's say there's a support level with which the market bounced and rejected off a few times, and it's not there yet, it could be a fake out. But then this is something that a trader looks for in a candle to understand where it's stepping in. But it can fail during strong sell-offs. It could be a complete, like, just a pullback just to show that there's sellers stepping out, but it could carry on. Not reliable in the middle of a range, like when it's, especially when it's ranging, like let's say there is a consolidation range right now, and the market is jumping between 44.90 to 4500, and it's in the middle of that, so it's at 44.95. It could be a complete non-reliable source of information. You can literally be stuck in that. And in gold sells, you want to be a bit more careful than a buy, because gold is a safe haven. It's an investment, and a lot of people would be in favor for the uptrend, the bull run, rather than the sells. A doji candle. A doji candle is a funny candle. It forms when the open and close are almost the same. It's very similar to the first candle, which was the spinning tops, but it's like the body is non-existent. So in this, you can kind of understand that it's a choppy market. It's misleading. Let's just wait. But whereas with doji, there's literally like you can't even see the body. So it represents indecision between buyers and sellers, similar to the other one. It just causes a bit more confusion. Highlights market hesitation, useful near support and resistance to understand. Maybe it's doji because it's now rejected a certain area, and there was no one doing anything at that point because it's a key area. Often appears before major moves. Very common. Before major moves, it just causes hesitation to all the traders, making them think that I don't think there's anything, and then boom, it just suddenly does that. But dojis are very dangerous. There's the drawbacks are no direction by itself, common in low volume markets, needs strong context to trade. Bullish engulfing. A bullish engulfing pattern occurs when a large bullish candle fully covers the previous bearish candle, as you can see right here. The previous candle was a bearish candle, but then the bullish engulfing candle came in, so the candle was a lot bigger than the previous one. It shows a strong shift of from sellers to buyers. Clean and powerful reversal signal, works well as support. Very useful. Very useful. Drawbacks: can fail in strong downtrends. Need location and trend confirmation. False signals in ranging market. In a ranging market, that's when you will see majority of the spinning tops, dojis, engulfings. You'll see them quite a lot in them. When it's a trending market, you won't see them much. You will clearly see just candles, just like how sometimes we go in a move and it just flies and it drops. Like that's basically when the volume is very clear and it's all very nice. Bullish and bearish engulfing is a lot in ranging market. On the other hand, bearish engulfing pattern occurs when a large bearish candle fully covers the previous bullish candle. Strong sign of selling pressure that a lot of sellers are now stepping in. Clear reversal structure. It could be clearly that the buyers are now stepping out and it's time to reverse for the market. Effective near resistance. This happens a lot at the support. This happens a lot at the resistance, and when it does, it's a good confirmation for a trader. Drawback: can be trapped by a long uptrend. It's the biggest drawback. A lot of times when I've gone in for a sell with the bearish engulfing, it's been a long uptrend. That's why my stop losses are so small, because I'd rather be stopped out quickly than be stuck in for ages and decades. And especially in sells, again, you just want to be a bit more careful. Requires confirmation, less reliable without context. These two are very powerful. Evening star especially. The three candle bearish reversal pattern, as I said, the three candle is not only in a consecutive direction, it's not only in a trendy or a straight movement, it could be even in scenarios like the normal markup. Strong bullish candle, small indecision candle, small bearish candle. That is a evening star. Benefits are: it shows clear momentum loss. It just shows that there was a volatility in one direction, and then it's just I don't know if you've noticed, sometimes I close my trade early is because I could clearly see an evening star. Like the market pushed, it's in a certain direction, it's given me the retest, it's now in a certain move, but the candle, the upper candle, second candle was the indecision candle, and then the bearish candle then comes and let's move stop loss ahead, let's be risk free, and it stops us, and it just goes in its own way. So that's very common and that's very useful when you're trading. The drawbacks are: forms less frequently, takes time to complete. Yeah, it's very slow, very slow. Like these usually perform on 15 minute, and you have to wait for like 45 minutes for it to be completely done to be 100% sure. And it can fail in strong bullish trends. It can very easily fail that. Morning star, a three candle bullish reversal pattern, strong bearish candle first, and then indecision again, and then bullish. Clear shift, same, very similar to what we've already studied. Like these are the same sort of drawbacks and profits. Three soldiers, three consecutive strong bullish candles, each closing higher than the previous one. It shows the benefit of bullish momentum, confirms trend reversal or continuation. Very clear structure. Drawbacks often appears after price has already moved. Risk of buying near exhaustion and poor risk to reward if chased. This happens a lot. Three crows, the three consecutive strong bearish candles, each closing lower than the previous one. So every candle is closing below the previous candle. It's not always right below it. It's always like from the little bit from here and a little from here, or half of it. Shows strong selling pressure, confirms bearish movement, and the drawbacks are entry can be late, but at the same time the market can still like be doing fake out, and it could be oversold and just turn around from there. Risk of shorting near support, another very major thing. Simple candlestick analysis. This is how big is the candle, where is the wick, is it at the top, is it the bottom, where is the candle forming on the chart, like is it in a ranging direction, is it near a area of interest, is gold trending or ranging. When ranging, we can see a lot of spinning tops, a lot of dojis, a lot of engulfings, but when it's trending, it gives you a confirmation of where you can look to enter. Context is also key when analyzing the candle itself. Ensure you are identifying the overall trend and higher time frames, because you want to be the friend of the trend and you understand that on a higher time frame. Mark key support and resistance levels. Wait for the price to reach a level. Look for candle confirmation. Enter after candle closes. Manage risk with stop loss. This is very important. Candlestick pattern cheat sheet for gold. This is more important than the rest of the information. The rest is, we've already mentioned this, it's very highly volatile. Expect long wicks and fake breakouts. Avoid with the candles, you want to be very careful. Engulfing, when you see engulfing, pin bar or anything like that during major news or small unclear candles against strong momentum, always wait for the candle to close. You want to avoid trading in these certain scenarios, because the majority of the traders lose when the market's not ranging. Not in a direction it's ranging, and when there's a lot of small movements, because the market makers are very clever. They do it on purpose. They make a person think and feel it's going in a certain direction, but then because they are ranging right now, they'll turn in, they'll take you on and do whatever they want to do. One line rule. In gold, candles work best at key levels with the trend after strong moves, never in isolation. So that was all about today's topic on candles.